Hi there and welcome to ET Now. I'm Ashwin Mohan and welcome to this special episode called Budget 2017, The Tax Effect, where we're going to take a closer look at some of the major tax expectations from Arun Jaitley and his A-team as far as this year's budget is concerned. And to throw more light on that, especially from a capital markets point of view, I have three leading voices from the world of tax: Subhankar Sinha from Siemens, Dinesh Kanabar from Dhruva Advisors, and Sudhir Kapadia from EY. Gentlemen, to all three of you, thank you so much for taking out time and joining me on this capital markets focus show as far as tax expectations are concerned. So, Subhankar, let's begin with you. And I want to start off by referring to a very important and significant statement made by Prime Minister Modi just a short while back, where he attended an event in Mumbai and he was very categorical in saying, and I quote, "Those who profit from financial markets must make a fair contribution to nation building through taxes. For various reasons, the contribution of tax from those who make money on the markets has been low." He added, to some extent, it may be due to illegal activities and fraud. Now, this is probably the first time that none other than the PM has directly raised a concern that the tax collections from the capital markets are not adequate. Though let me add that it was the FM also tried to soothe the nerves of the markets with a statement in defense saying that the PM's statement was misquoted. But do you think these are early warning signals coming in from none other than the PM himself that there could be a potential tightening of capital markets tax policy in this year's budget?
I would tend to agree with you, Ashwin, because frankly speaking, I was also a bit surprised when that statement came from the Prime Minister. Of course, the FM has subsequently clarified it. And also, I find it a bit odd because if you remember a couple of years back during 2015 budget, FM specifically invited the foreign portfolio managers to relocate to India, and he also talked about easing the permanent establishment regulations, and we haven't seen much positive response after that, despite the change in laws.
That's right.
So to that extent, I see a slight conflict from a policy perspective, but I think it's clearly a signal that some changes on capital gains tax front are perhaps offing in the budget.
Mr. Kanabar, do you think it's mostly political compulsions that made the PM make this statement? The FM, of course, knew that the markets would go into a tizzy, so he clarified, as Subhankar was also saying. But looking at the current atmosphere, looking at the fact that India is still reeling under the effects of demonetization, and hopefully the long-term benefits will be better compared to the short-term pain. But looking at the current atmosphere, do you think this is perhaps the right time to tweak with the capital gains tax policy?
If you look at the statement, what he went out to say was that for long, India has been virtually like a tax haven for investors on the capital market side. He went on to speak about how India has renegotiated the tax treaty with Mauritius and how Singapore was happening on the cards. It's very unusual for a prime minister of a country to talk about tax treaties, but he went down to that path.
He went down to those nitty-gritties, yeah.
Correct. And then he went on to say, in that context, that people have been benefiting from the stock market but are not contributing adequately. And we straight away read that particular sentence without the preamble which he gave earlier, that some of those loopholes have been plugged. So he was basically referring, as I could read it, to say there were issues regarding blatant misuse of treaty, albeit permitted by the government thanks to whatever circulars and whatever else, but that was something which was a thing of the past. The treaties have been renegotiated, now people have to pay taxes. And he made actually two statements. The first statement which he made was with respect to the markets itself. He said the markets were created for cash transactions but were being used more for derivatives. That was a tail wagging the dog. And then he went on to say that the markets were supposed to contribute fairly to the growth of the nation. That wasn't happening.
So you think the PM was basically referring to illegal activities and fraud and plugging them a little more rather than plain vanilla transactions where people make gains? Sudhir?
If you take one statistic, you see a very significant spike in securities transaction tax as of December. It's 52% increase, which took me by surprise.
That's staggering. Yeah.
So we went and tried to find out that is the number of transactions increased. Actually speaking, very interestingly, it looks like the number of derivative transactions has really gone up substantially. So in a way that does buttresses that part of the PM statement to say that, perhaps a lot of people are benefiting from derivative transactions, and that is borne out by the spike in the STT collection as well. That's an interesting statistic as well.
If I just add on a bit to that, when you speak about misuse and illegal activities, Probably it has a lot to do with SEBI and how the activities are monitored as opposed to the tax laws itself. So for example, if there are companies whose shares are used to jack up prices and create long-term capital gains, that's actually illegal activity per se. There is nothing which you need to do about law. There has been enough and more in the law, really, whether it is in terms of bonus stripping, etc., which has come through over a period of time.
Subhankar, I want to stick to the long-term capital gains tax component and highlight the fact that the last budget had increased the minimum holding period for unlisted securities to 2 years. Do you think the government might use this as an excuse to extend this rule to listed stocks this year? And could we perhaps see a change in the terms of the longer holding period for stocks? So maybe the exemption stays, but the eligibility criteria is extended from the current 1 year, say, to 3 years. Do you think that could be a less controversial manner in which the government could perhaps send a signal to the markets and also tell the markets that we are favoring long-term investors?
No, I would like to look at it slightly differently, because we are also hearing about reduction in corporate tax rate, which the finance minister already announced. It will be brought down to 25%. Now he has given certain roadmap for that in terms of bringing down the rate and also removing certain exemptions and deductions. Now today the government is collecting roughly around 5 lakh crores from corporation tax. Now if he wants to front end or prepone or give higher deductions in the initial year, suppose there is a 2 percentage point drop in the corporate tax rate, in order to balance the tax collection, there might be some tweaking in the capital gains tax regime. So that might be possible.
Sudhir, so being consistent with the FM statement, which immediately followed the PM statement, so say you go by the FM statement, LGCT tax is not introduced, but maybe the qualification or the eligibility criteria is extended. Would you concur? Do you think this is the right scenario for that to take place?
It cannot be ruled out, of course. Now, it's a subjective view about what do you mean by long term. If you scan around the world and say that, is anywhere long term defined as just 1 year, you will probably struggle to find a definition which says long term is equal to 1 year.
So do we have the strictest policy in that sense?
No, we have the most liberal
definition of long term.
So we have the most liberal, right?
Okay.
But then we are also a country where equity participation is 1%, as opposed to 50% in the United States of America. So we have to also put that in the right context. That is it the stage when we want to kind of actively discourage participation in equity, particularly when you see such a big increase in mobilization with the mutual funds, particularly post demonetization as we saw. So I personally think timing wise, I don't think the government will gain much by trying to tinker with it. And I also, to Subhankar's point, in principle, yes, you might try to find ways to increase revenues in other buckets. Intuitively, I don't think the increase in tax revenues by increasing the holding period to 2 years will be significant for the government to tinker with it. That's my gut feel.
Do you expect the long-term capital gains tax exemption to be done away? Yes or no?
No.
Yes or no?
Absolutely no.
Yes or no?
No.
All right, so that's some good news for the markets. Now let's shift our focus. In fact, Sudhir, you led into my next question, which is on short-term capital gains. Now I know that tinkering in one aspect cannot be looked at as a mutually independent exercise. Right. It is dependent on other aspects as well, and that's where I want to bring in Dinesh. Dinesh, what about short-term capital gains tax? All three of you are very optimistic that there will be no change to the LTCG tax policy. But what about short-term capital gains tax? Perhaps in a bid to encourage investors to take a longer-term perspective and qualify for exemption, maybe the short-term capital gains tax component could be raised or hiked from the current percentage to a higher one?
So two parts to it. First is take FIIs and foreign investors. With a view to assuage their apprehensions, the law was changed to say any income arising from investment in equity to FIIs will be treated as capital gains and not be treated as business income. But the fact of the matter is that there is probably very precious little to distinguish short-term capital gain and business income. And if you look at FII activity where shares are bought and sold over a week period, a fortnight period, is that really a short-term capital gain or a business income? So you have deemed what is otherwise potentially a business income to be a short-term capital gain, really. So that's one thing, and that probably is going to hurt the FIIs now in a negative manner, because in the context of a business income, they might have potentially not been liable to tax if they did not have a permanent establishment. Today, because the income is deemed to be capital gains, short-term capital gains will be liable to tax. So what was stated to be a policy for the purpose of providing certainty to FIIs is today becoming, because of the change of law, counterproductive. And this is the biggest pain point for FIIs today. If you ask any FII what's the concern, their concern is short term, there is GAR coming in, therefore no treaty benefit available, and straight away I'll be liable to capital gains tax, whereas if I had a business permanent establishment, I would not be liable to tax.
I think the government needs to keep the GAR aspect in mind. A quick take from Subhankar before we move on to other tax policies that could impact the capital market. Subhankar, you belong to a large conglomerate which has global presence. On the capital gains tax front, how have you seen other jurisdictions treating this aspect?
Well, I mean, from a corporate perspective, I think a couple of points I will make. One is we would certainly prefer a continuity in policy, no certain surprises, because that's really important for us. And the other thing I would suggest, I mean, I would look forward is, some kind of rationalization when we do a group restructuring. For example, today we have a situation, if a foreign company has to sell the shares of a listed company off market due to certain regulatory restrictions, it has to straight away pay tax at a higher rate of 20%. Although under the law, you have the benefit of paying tax at a lower rate of 10% if it's unlisted securities. So those kind of rationalizations, if it is brought about, that would be highly welcome from an MNC perspective.
All right, Sudhir, you want to add to that?
Just to your earlier question, see, most countries do have a capital gains tax regime. Let's face it, around the world. The difference is many countries, particularly the developed ones, have taken a view conventionally that other than for real or immovable property, they will not tax non-residents on sale of shares of the companies in those countries. So they go with what is popularly called a residence basis of taxation. And I think most developing countries have gone the other way to also include capital gains tax as a source-based taxation, be it India, be it China, be it some other issue. In my view, that difference will remain. Like for other categories of income, emerging markets, developing countries would like to tax on the basis of source and not on the basis of residence.
It'll be interesting to see this because the finance ministry has always been saying that it wants to adopt the best global tax practices. So let's see which side of the wall they lean on. Now, I want to take a cue from Dinesh's initial comments when we began this discussion and speak about the illegal activities and fraud bit. And here's where the PM said something more. He went on to add that to some extent, the low contribution may be due to illegal activities and fraud. To stop this, SEBI has to be vigilant, which substantiates Dinesh's point. And to some extent, the low contribution of taxes may be also due to the structure of our tax laws. Low or zero tax rate is given to certain types of financial income. Dinesh, what are these types of financial income which are perhaps low-hanging fruits, which could be looked at in the budget?
So first, obviously, where is it that there is no rate of tax, and which is again long-term equity and equity-oriented funds. And then you have short-term on listed securities, etc. I think the worst thing which can happen in this budget is really the non-continuation of the low rate of tax which is given to cross-border interest. And I think that's something which needs to continue for a period of time because India needs those funds. A 5% rate of tax on cross-border ECBs is something which I think is very, very necessary. Again, ECBs are highly regulated, so there is no question of leakage or any which way, but that 5% is very, very necessary for capital formation.
All right.
The only other thing which I would put really is that, as we discussed earlier, if you are going to create short-term as business income, that probably to my mind is the most low-hanging fruit.
All right. Subhankar, your choice in terms of the low-hanging fruits?
Yeah, there is a good chance that that might happen, that we might see some spike in the short-term capital gains tax rate, as Dinesh is saying.
All right, so we'll look at some other aspects beyond what the PM said on the other side of the short break. It's time now, as I said, to slip into a short break. Stay tuned and keep watching ET Now. Budget 2017, the tax effect, comes up on the other side. Welcome back to Budget 2017, the tax effect. I'm Ashwin Mohan and I have with me three tax experts who are going to dissect some of the important proposals on the capital markets front that can be expected from Arun Jaitley and his A-team. Subhankar, what about debt instruments? That's also an interesting aspect. Do you expect any action on that front? And more importantly, there's always been this niggling controversy about the distinction between a foreign company and an Indian company. There's been litigation on that front as well. These two aspects, do you expect there to be any clarity in the budget?
I don't expect any major change on the debt instruments, but as Dinesh was saying, its foreign capital is very important for the country, and therefore I would expect some kind of continuity on the policy that we have on external commercial borrowings, ECB, and I expect that rate of 5% to continue. Other than that, I don't see any major changes coming up on the debt front.
Dinesh, would you like to add to that?
So on the debt market instruments itself, they are covered. They don't have the same exemption as equity market, albeit at a lower rate of tax. And the one important thing which most foreign investors have complained is that the debt market in India is not developed the way it is globally. There was a reference earlier which Sudhir made with regard to what percentage of money gets channelized into equity markets. But leave even equity markets aside. Today, the amount of money sitting in bank deposits is so disproportionately large compared to anywhere else in the world. It's just important that these monies get channelized into both equity and debt market. And towards that end, I would believe that there is no rational basis on which the tax treatment on them needs to be changed.
Now let's shift focus to STT or Securities Transaction Tax. Subhankar, STT is a very clean administrative process where it's a very smooth functioning, wherein the government is getting close to around 7,000 crores every year. If you look at the current STT, it's in the range of 0.017% and 0.125%. Could that be possibly hiked? Because keeping in mind with what the PM had initially said, that there is not enough taxes being paid by people who make money from the markets. Though let me hasten to add that STT is paid irrespective of one makes a profit or a loss. It's more transaction based. So do you think this is one easy way wherein the government could look at more taxes from the capital markets by hiking the STT from its current rate?
Yes, that's correct. I mean, STT is a mechanism which is a delight for any revenue person because it's fairly automated collection. But if you are talking about an increase in STT, that will be always accompanied by a decrease in the the capital gains tax rate. So that part is fairly certain that if STT goes up, you can expect certainly a change in the capital gains tax rate to come down. On the other hand, if there is any increase in capital gains tax rate, we might see a reduction in STT.
So the government has to take the plunge somewhere at least. I mean, I'm 3/4 through this discussion, and on many aspects, most of you are not too sure whether the government is going to take the plunge or not because of the kind of impact or the kind of feedback that might come from the investors and the capital markets. Why not STT? I mean, this looks like the least controversial way of getting more taxes.
So I will make 2 points here. One is after the fact that 3 treaties got amended in just 1 year, something which for 3 decades were considered as holy cows, with just because, oh my God, the markets will tank, what will happen? You have to understand that we are dealing with a government, needless to say, after demonetization more so, who is not afraid to take risks. Now coming to STT,
yes.
We have to remember that there has been a mission creep there. Already some increases have happened. It's not that they have never touched it. There is no reason why some minor tinkering or increase cannot happen.
We expect a minor rate hike at least?
I think if they change the short-term capital gains tax in any which way, then you can also expect some changes in the STT is first point.
All right.
Second point, just to complete it, it's a transaction tax, which is by nature not progressive. So the temptation will be from a progressivity point of view to tackle short-term capital gains tax, which is on income, rather than a transaction tax which applies across.
Sure, conceptually at least. Yes. Subhankar, what are some of the market routes and avenues which have been, historically, perhaps, if I might use the word, misused by domestic as well as overseas investors, and could translate into fresh revenue collections? Zero coupon bonds are listed. They get the same tax treatment as equities. Bonus stripping continues unabated. Do you expect budget 2017 to perhaps remove these anomalies?
Yeah, I think bonus stripping is one area where there could be some tightening of the rules because currently you have a 90-day window period. But even despite that, I think some misuses are still possibly happening in the marketplace.
So what's the kind of tightening that could curb that misuse, Subhankar?
So if you are doing a transaction within that 90-day period, currently the concerned losses are not allowed. But if that window is further extended, then I think this kind of transaction will be discouraged. So that's one area where we could see some changes possibly.
What's the kind of window that you would look at, perhaps? A safe window? From 90 days to?
It might be increased to 6 months.
All right, wow, as much as that. Dinesh, do you concur?
I just wonder, why do you need to change it at all? Because it's a specific avoidance rule. And you also have a general avoidance rule. It is an accepted position that GAR will continue to apply even where SAR applies, although the request is it ought not to. So if there is an abuse, so there is a specific provision, and if there is still an abuse which is general, it will be tackled. You don't need to go on changing regulations every bit.
Let's move on to the tax treaty bit. The government has recently amended various tax treaties, be it Mauritius, Singapore and Cyprus, to remove the tax advantage that foreign investors have had over domestic investors. Directionally or in terms of statements, is there scope for any other treaties to be tightened to distill the money, Subhankar, that flows in?
I don't think so, because whatever round tripping, I mean, that was the biggest concern, one of the biggest concern from all these countries that was happening. It was primarily from Mauritius and Cyprus, and Singapore, of course, has been used to an extent in the recent past. Now, once you have managed to block that, I think 90% of the problem is solved. So beyond that, I don't think any further treaty negotiations are coming up in the near future. But of course, we will also see the emergence of multilateral instrument, and I don't know whether any kind of tightening can happen through that route as well. That's something we have to wait and watch.
Sudhir, on the treaty front?
I think the trade, as I mentioned earlier, the three main treaties where this capital gains exemption in an absolute sense was available, you have already addressed. So part of the walk the talk of the Prime Minister after that statement has already been seen in terms of the amendment to the Singapore Treaty before the year end. So they have done the main work has been done. As Subhankar said, you will have the multilateral instrument coming in, you will have GAR coming in. I think the ability is very clear, the signal is very clear that don't expect to get treaty protection if you are merely using simply a stepping stone for a jurisdiction. We will only give you protection if you are a bona fide resident with substance. I think that's very clear. So you will see steps more in the area of response to BEPS rather than tinkering with individual treaties going forward, because the main three are taken care of.
Anything in the budget that you expect?
I don't think in budget. So BEPS, as Sudhir rightly mentioned and Subhankar mentioned about MLI, really have all been speaking about substance, and substance not merely in the context of a tick the box, but really a genuine presence to be enabled to be taking the tax treaty. That is not something which is required to be set out in a budget, because the interpretation of treaties can't be unilateral, it's bilateral, it's right out there. And the question is, once India becomes a signatory to MLI, which it has said it would, and there are so many other countries which would be, then really the substance would be the key driver to be eligible to any benefits from a tax treaty.
All right, gentlemen, we are running out of time, so it's time now for closing comments. Subhankar, one aspect of capital gains tax policy which you are putting your money on will be introduced in the budget. What would you say that would be?
I would like to see some kind of a roadmap, as the FM has given for corporate tax, some kind of holistic strategy for capital gains tax as well.
All right, Dinesh, what would that one specific aspect be which you think will be introduced?
But I think I would agree with Subhankar. We have had SHOM committee report talking about how capital gains tax should actually be done away with or done in a very different manner. And there has been always this speculation as to what is it that the Indian government wants vis-a-vis capital gains. A clear direction saying that this is the roadmap for the next 3 to 5 years is something which would be very, very welcome.
Sudhir, would you concur with these two?
I would, and apart from that, I think one other thing which I certainly expect will come in this budget is what is not possible to be clarified through a circular as far as indirect transfer is concerned in respect of FPIs. You will see an amendment in this budget to once and for all close this uncertainty about taxation on indirect transfers. That is certainly expected in the budget itself.
That will be music to the ears of the foreign investors. On that note, let me thank Subhankar Sinha, Dinesh Kanabar and Sudhir Kapadia for taking our time. Engrossing discussion, gentlemen, as always. Thank you so much.
Thank you.
Thanks, Ashwin.
Thank you.
With that, we have come to the end of Budget 2017, the tax effect. So when it comes to long-term capital gains tax, short-term capital gains tax, the FPI policy, tax treaties, securities transaction tax, all of these aspects are deeply interlinked. So it's going to be a tough balancing act for the government. Let's wait and watch to see how Arun Jaitley delivers. Stay tuned to ET Now for more news and updates.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.